Good morning and welcome to the AUDUSD Securities Markets Update. The US dollar sold off yesterday across the board again after a series of disappointing economic releases from the US, leading the US dollar index to decline further to the lowest level in almost a week, trading around 97.50. And this is basically after, first of all, we had the building permits, which basically declined beyond the market estimates, declining by 5.7% in March after rising by 4% in February, while it had been anticipated to decline slightly by only 1.9%, and this is the biggest monthly decline since May of last year. The housing starts also came in with another disappointment, rising by only 2% in March after declining by 15.3% in February, while the estimates were to rise by at least 15% or 15.9%. The weekly jobs claims also unexpectedly increased last week toward 294,000, up from 282,000 the week before, while the estimates, while it had been anticipated to decline toward 280, and this is the highest claim since March the 30th. However, it remains near the lowest level since 2007. The only positive news, or the only positive number, was the Philadelphia Fed Manufacturing Index, which increased towards 7.5 in April, up from 5 in March, while the estimates also were to rise slightly toward 6 only, and this is the highest level since December of last year. These figures has led also the Bloomberg Economic Surprise Index in the US to decline further again to a new 7-year lows at minus 0.76, which shows that this is the most disappointing economic releases for the US since 2009. And these data also eased the speculations for rate hike by the Federal Reserve in June. Yesterday also, 3 members in the Federal Reserve noted that the recent data were mixed, and it would be better to wait for further data and further evidences before raising rates. During the Asian session today, there was only one economic release in Japan, which also had no impact on the markets. The Consumer Confidence Index increased slightly toward 41.7 in March, up from 40.7 in February, while it had been anticipated to rise only toward 41.4. As for the European session ahead, there are a few economic releases which are likely to have a major impact on the market ahead of the weekend from Switzerland, the Eurozone, and even in the UK. Beginning with Switzerland, the retail sales is expected to rise slightly by 0.7% in February after declining by 0.3% in January, which would be also the biggest increase in 2 months. In the Eurozone, the current account surplus may decline slightly toward 29.1 billion euros in February, down from 29.4 billion euros in January. Moreover, we will be waiting for the final reading of the CPI and the core CPI for the Eurozone today, and the estimates are to remain unrevised at minus 0.1 and 0.6 respectively. The most important event during the European session today is the UK jobs report, which is likely to have a major impact on the British pound, but the main focus will be again on the average hourly earnings, which is expected to remain at 1.8% in February. The claimant count change also may decline by 29.1 thousand in March, compared to a decline of 31,000 in February, which remains also within the same trend or within the same range of last year. Finally, the unemployment rate is expected to decline further again toward 5.6% in February, down from 5.7 in January, which would be also the lowest level since 2008. As for the US session today, it's all about the inflation data from the US and from Canada, which is likely to have also the major or the biggest impact on the market, especially if the figures comes in with more surprises. We will be waiting today for the inflation data from Canada, in addition to the from Canada, and the retail sales also from Canada, while eyes will be on the US inflation and the consumer sentiment index. These are the economic figures for Canada: CPI, core CPI, retail sales, core retail sales, in addition to the inflation data from the US, in addition to that University of Michigan consumer confidence. But before we leave you today, a quick technical update on the pairs that we discussed yesterday. First of all, the euro short squeeze continue, reaching as high as almost 1.0820, while the next stop could be around 1.0839 or to 1.0840, which represent a 61.8% retracement from where sellers are likely to appear. But the invalidation level for the sellers right now stands at 110.36, which is this month's high, also the one that we've seen at the beginning of this month. In addition to that, this is yesterday's chart, and this is the chart that we've seen lately since the beginning of the day, or since the market. Right now we're trading about 1.0774, but we might see another rally, as I noted, at 61.8%, which is 108.39, 108.40, where sellers likely to appear and may continue to decline or may resume the downtrend from there. We had also the dollar CAD out yesterday. This is also yesterday's chart. After breaking below the key support level that we mentioned was around 123.90, it continued to decline further yesterday, again toward 121.80. So, however, we still think that it might continue to decline during the day, especially if the numbers came in with much better than expected for Canada. Right now, we might see further declines toward 1.2060, 2050. This would be the next level to watch. In addition to that, we discussed yesterday the New Zealand dollar, and we noted that further rally could be seen as far as the trend continue to hold. We continued to rally yesterday, reaching as high as also the invalidation level for the sellers yesterday. It was around 76.97, and we reached even 76 or 77. So right now we believe that it might be good to wait and watch the market for today, especially for the New Zealand dollar, because we have no data from New Zealand, but we will be waiting for the US data, which might continue to support the pair as far as also the trend continues. Finally, we spoke about the Aussie yesterday. It is still within the same level, within the same short area, with the same support or the supply zone, which is at 61.8. It's at 77.84 yesterday. We ended up at around 78.10, but it remains within the same area. The invalidation level is at 79.40, 79.40 or 79.38, which should be watched very closely. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube to get the latest economic releases, reports, and announcements. Thank you for watching. I'll see you once again next week.